Meta Platforms. It is my big dog stock in the public count, $977,000 position. We're up $776,000 on this stock, not including the dividends it pays me, right? Now, here's the deal. Meta right now pays you $2 for each share you own of Meta stock, right? But it's a baby newborn. It's a baby newborn, right? It's a new dividend payer. They just paid their first dividend in history back in February of 2024, right? 50 cents. And so look at this and get ready to have your flapjacks flipped, right? They pay 50 cents a quarter. Look at their earnings per share. Now keep in mind, they pretty much beat their earnings per share almost every single quarter in regards to what analysts are expecting. So don't be surprised if these numbers are too low and Meta comes in and smashes these numbers over the next few quarters. But even given analyst expectations here, 529, 634, 525, 580, 624, 750. Run the math on that. That's under a 10% payout ratio. This means Meta has a ridiculous amount of room to up that dividend significantly over the next 10, 20 years. And imagine what their earnings per share is going to be like at that time. Are we talking about a company that's bringing in $10, $20, $30 a quarter in earnings per share? It's a real potential, right? Now, also keep in mind, Meta's still a young business. I know we think about like Facebook's old, it's new. Like in the realm of business, you got to understand, more mature businesses are businesses that have been around for 30, 40, 50 years. Those are more mature businesses. Those are more the usual dividend stocks that pay you out the dividend money and whatnot. Facebook is like brand new compared to those companies. Facebook Messenger, WhatsApp, Instagram, the big platforms that this company dominates on, these are still baby businesses. Imagine where these business models are going to be 5 years, 10 years, 15 years out from now, right? It's incredible when you think about it from that context. So Meta's my big dog, and I project Meta will start paying $1 per quarter in dividends very shortly here, which is equal to $4 per year in dividends paid out, right? So given my 1,700 shares times the $4 are going to likely pay out here, I'm going to likely start making $6,800 a year just off this one stock in dividends. And then I believe probably either in 2026 or 2027, Meta will start paying me 5 figures a year just to hold the stock. I'll make 5 figures a year from just holding the stock. That is pretty awesome, right? And so that's like I said, when the numbers start getting bigger and bigger, things start to get a lot of fun. Because basically, how I think about this, right, is Meta's going to start paying me out 5 figures plus a year in dividends. That gives me an additional 5 figures plus a year. I'm going to be able to either put back into Meta stock and acquire more shares so the dividend amount gets even bigger, or go buy other opportunities out there, which we know is always an incredible opportunities out there in the market, right? And so imagine Meta's paying me out 5 figures plus in dividends, and the market's in some sort of correction or crash at that time, and I'm able to stick that 5 figures plus and buy, great companies with it, right? And remember, this is just one stock I own, never mind all the other dividend money coming in all the time. This is why I never fear stock market crashes. Some people get really scared. I'm not scared. Like, my dividend companies are so stable that they'll keep paying out huge dividend sums of money, right? And then I get to turn that money around and invest into great companies. If you tell me prices are going to be lower, that's phenomenal. That just gives me a greater opportunity to buy with all this dividend money I got coming in all the time, right? That's the fun with dividends. Now, next stock up here, it's called a sister company, right? This next one, number 5 of these 7 dividend stocks, and that is Google McDougal, the other advertising giant. Yes, Google's now a dividend-paying stock. This stock's up 18% year to date. It's definitely been a lagger stock, which I'm very happy with because this is like a stock I literally just started buying a few weeks ago or so. And so this is a pretty opportune time I look at from kind of a perspective of buying Google shares. So this one started out with this small dividend. It pays you 80 cents a year for each share you own of Google, right? Very small, modest amount. But keep in mind, that dividend's likely going to be going up significantly over the next few years. They have so much room for dividend growth in regards to this one. It's ridiculous. They're expected to have, remember, Google's also another company that beats their earnings per share very often. So analysts have them doing it $1.84, then $2.04, $2.01, $2.17, $2.16, $2.41. And they're paying 20 cents a share in dividends. That's like a 10% or under a 10% payout ratio. There's so much room for expansion of this company paying bigger and bigger dividends. It's ridiculous in regards to this one. But the exciting thing in regards to Google is it's not just about the dividend amount, and they're going to be able to raise that significantly over the next 5-10 years, right? But check this out. I want to compare Google versus two peer companies, Apple and Microsoft, right here on 1000xstocks.com. And what we're going to find is Google wins in almost every category, right? So trailing 12-month PE, Google's the most attractive, right? At a 23 versus Apple's at a 35 and a 35 for Microsoft. Forward P, Google's at a 20 versus a 32, almost 33 for Apple, and a 31 for Microsoft. 2-year forward P, 17 for Google, 31 for Apple, 27 for Microsoft. And so it wins that category. Trailing 12-month earnings per share, 47.5% for Google versus 10% versus 22% for Microsoft, right? They win that. Current year expected earnings per share growth, about 34% expected for Google versus 7.5% for Apple and 12% for Microsoft. Next year earnings per share growth, that's the one they get beat at, but they hardly get beat at that. Microsoft analysts have them at 16.9% versus 16.4% for Google, right? Trailing 12-month revenue expected here for Google, 13%. Current year expected revenue growth, 14.7%, and then next year revenue growth expected 11.7%. So, when it did get the twos in these categories, it's like a really close two versus these, it's like way under. So Google's valuation is very attractive, which means this is a company that's likely going to raise their dividends significantly over the coming years. And the share price is going to, produce some great capital appreciation in regards to Google. So I love this overall. I just started the position here very recently in the Patreon portfolio with a few shares, and I'm looking to build that up significantly. By the way, we only have 2 positions here in the red in the Patreon portfolio right now. So that Patreon portfolio is a banger, man. An absolute banger. If you want to see the stocks I'm buying and selling each week in that Patreon, once again, that's going to be the first pinned comment down there today. And to get in before the prices go up in regards to those 2 tiers. Additionally, the second pinned comment down there today, if you want access to all my premium courses, if you also want access to my private groups Discord chat, which is a whole another level of 6 and 7 figure members, and if you also want access to 1000xstocks.com, we can bundle all that together for you. That will be the second pinned comment down there. The Patreon's more for, think about the Patreon as kind of like maybe in your first couple years of investing. Think about the private group as kind of like you're a little more experienced, you got more money behind you, you're a little further on, in your journey and things like that, okay? How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area. Meta's revenue has room to run.
Meta among the names reporting next week. My next guest covers all 3, but is singling Meta out today. He's reiterating his buy on the stock and raising his price target to $6.75. This on the company's ability to generate double-digit revenue growth despite all of their AI spending. And the stock is up 60% this year. Brent Thill is here now. He's an analyst at Jefferies. And Brent, Meta's been one of the great stories. You think its run continues? This is akin to what we were saying about other outperformers lately, like gold, like Bitcoin.
Yeah, Meta is in a great spot. They continue to take market share. They're in the right position with AI. Zuck has been lifting weights and wearing cool T-shirts with the necklaces and kind of staying out of the way. And I think advertisers have appreciated his workout routine, which is helping the overall business. And we continue to think they can sustain mid-teen growth. You're on a pathway to get to $30 of earnings power. If you look at other leaders in AI, Microsoft, NVIDIA, others, they're all trading at 30 times earnings. If you get to $30 of earnings power in a year or two and you merely put a mid-20 multiple on it, you're going to get a much higher stock. So we think...
Boom, boom, boom. Let me pull you something up here. Alrighty, so on 1000xstocks.com here, I want to go to compare right here to this particular tab. And I want to show you, I want to pull up Meta. We're going to pull up Meta here. And I'm going to pull right next to it Apple. Okay, we'll pull Apple up, and then we'll pull up, let's pull up Mr. Softy too, Microsoft, okay? And I want you to see something here. So if we look at forward P of Meta, 26, right? And Meta does usually destroy their earnings estimates, so that could be lower actually. Apple's at 32, Microsoft's at 31. And that's fine if you were of the assumption that Apple and Microsoft are going to far outgrow the earnings per share of Meta, right? But that's just not the reality. Current year expected earnings per share growth at 43% for Meta versus 7.5% for Apple and 12.3% for Meta. Trailing 12-month earnings per share is 134% for Meta versus 10% for Apple and about 22% for Mr. Softy. Next year earnings per share growth over 11% for Meta versus 8% for Apple and around 17% for Microsoft, right? So overall, and as far as revenue growth goes for Meta, around the same as Microsoft, right? So the moral of the story here is Meta is significantly undervalued versus these two other peer companies being Apple and Microsoft here. And I look at Meta as having tremendous amount of upside. And like this gentleman points out, it's significantly undervalued. It's significantly undervalued, and you're going to get likely big. I've always imagined Meta being 700 plus before the end of this year. I think they could get there.
Again, the risk is the stock's had a big run. Many things I'm talking about are known. They've had a great trajectory. Do they have to raise CapEx higher than the street has it? We think there's a risk. Do some of the advertising data points start to soften a bit as we get outside the election cycle? There's a handful of concerns that we have, but we do believe, again, in this durable $25 to $30 of earnings power. And when you think about, you don't have to put a big multiple on it to get a higher price, even while the stock has had a big run.
Can we turn to Microsoft, which I believe...
If you just slapped a similar PE on it, forward P that Apple or Microsoft has, I mean, right there, you're already over 700 right there.
Cover. I mean, that one has been underperforming, even the S&P this year, as more people are wondering just how impactful Copilot will be. Incredible to watch it go from first out of the gate, showered with positivity and praise for everything it was doing with OpenAI and on the AI front. Now seems to be playing a bit of catch up.
Yeah, I think everyone was overweight Microsoft, Kelly, and they're basically just selling the stock. They're going into other names. They're going to energy. They're going outside tech. They're going to financials. They're going all other places. And so I think Microsoft...
Yeah, the main thing with Mr. Softy is just like the valuation is not super compelling here, right? Trailing 12-month P of 35, 36, forward P around 32. I wouldn't call it overvalued, but it also is not just at a level of like making people excited, like, oh man, Microsoft's such a great deal, I gotta go buy that stock.
It's had great fundamentals. It's one of the best management teams. It's one of the best CFOs that we work with, Amy Hood. You effectively right now are just seeing a broadening trade. There is no AI in software yet. We've talked about this. It's better to be a semi and hardware analyst. Those stocks are up 50 to 150%. Software's up low teens, and it's underperformed everything. And it's because there is no AI in software today. There is no material monetizable revenue in a big way. Now, Microsoft's monetizing it better than anyone, but it's still a low single-digit % of their total revenue.
I mean, you're striking an upbeat tone to say that it's not in there yet, whereas some say it's, killing the whole sector, and you're more arguing that, its transformation has yet to begin and could pay off. Yeah. Just to get inside baseball for a second on the Salesforce piece, which Jeff Smith was talking positively about this morning, given the changes there the past couple of years. Benioff was also criticizing Microsoft. We talked about this on the show yesterday, the way it's trying to now talk about agents as a way of delivering or boosting the impact that its AI Copilot can have. And Benioff's dismissive of that, which implies that, Salesforce now sees itself in a bit more of a better position than it might have been a few months ago. Do you agree with that?
This is nonsense. I'm a huge fan of Mark, but that's nonsense. Microsoft's revenue is so much higher in AI than Salesforce. I mean, Salesforce is in a good spot with Agentforce. We're a huge fan, but that's marketing, and Mark's really good at marketing. So we think Microsoft, again, is the furthest out. They started this revolution. They partnered with the best company, OpenAI. They've had the most revenue impact. While it's still tiny, they are in an incredible position. So it doesn't matter if you rename it Copilot, Agent, whatever. It doesn't matter. There's a bigger, meaningful chunk of revenue at Microsoft than at Salesforce at this point. Okay, so that's just the facts. So Mark's good at marketing. That tweet is or X link is I think is more.
Like I always say, Benioff, he's the best salesman in the world. Certainly
Post on X or whatever we call it. So Brent, heading into the thick of earnings season and with some of what the comments you've just made about software and the rest of it, are there other areas of opportunity investors can get ahead of now, places that we might see, upside beats, or even over the longer term, 6 to 12 months time? Are there a few of these names that have been left behind that you think are going to catch up?
Yeah, I think software is going to play catch up. Again, all the software companies are buying the AI infrastructure, so this has to work. And if we get this AI rolled out in 25, 26, software will play catch up. So I think software as a category, the IGV is the index. You buy the IGV. We think other companies like Snowflake, who's one of the worst performers year to date, that can be a catch up trade for 25.
Yes. Well, I mean, Snowflake, could I buy it eventually? It's a stock I could potentially end up buying at some point in time, but yeah, still not interested in that one. Let's check out Snowflake's valuation here. I just want to zero in on Snow. So let's check out Snowflake. Jeez. 152 forward P, 2-year out forward P, 116. Current year expected revenue growth 29%, expected to decelerate to 22% next year. Analysts have here. Let me go to, I want to go to the charts feature here on Snow and see what's going on here. So take a look. The trailing 12-month revenue, certainly a very nice uptrend here for the company in terms of that. Gross margins looking pretty good, but not great. I mean, Snowflake, I would think, would be well over 70% margins, if not closer to 80%, right? I mean, Palantir is an 80% plus gross margin company. If we look at a trailing 12-month EPS, I mean, it's been ugly, right? Very, very ugly in regards to their earnings per share. They are expected to turn that around here, so that's good news for them. But, yeah, it's been a big money loser over time. Now, this is exciting for the company. Free cash flow on a trailing 12-month basis has been booming, so that's good. And then if we take a peek here at operating cash flow, that's been coming up very strong. Shareholder equity has been downtrending for Snowflake, so not great news as far as that goes. So if there's one thing to be excited about in regards to Snowflake, it's that they're flipping to profitability, and it's that their cash flows, free cash flow and operating cash flow, have been increasing immensely. I don't know if that will continue like that as far as free cash flow, because they might have to spend heavy on AI chips. I don't know. But that is a potential. And if they do, that could potentially hurt their free cash flow a little bit. But it looks like their operating cash flow is definitely in a nice trend here. So, yeah, the moral of the story is Snow might get interesting here. It's just not quite there yet. But it might, never know. What happens if the stock goes under 100 next year? Maybe I make a move there.
CEOs come in and put new infrastructure and routes to market and development in. That could be a catch-up trade for 25. We think the hyperscalers are still the best ways to play this. Microsoft, Amazon, and Google. Microsoft and Amazon particularly. So our AI trade for enterprises, Microsoft and Amazon. For consumer, we really like Meta. And
it's crazy. People were just willing to pay anything for Snowflake shares a couple years ago. Like anything. Like, give me Snowflake.
Those are kind of the four big names are going to benefit the most.
And obviously those are more consensus, but I'm very curious to see if you're right about Snowflake and the IGV and software participating more broadly.
Okay, next one up here. He was a big, huge bear, Mike Wilson. I can't wait for this one.
To say it's just been tech, because the reality is that if you look at the technology sector in an equal weight basis, or just look at the average technology stock, it's actually underperformed the S&P 500. What's really worked in the last...
Holy smokers! This guy's got more dang Morgan Stanley branding than I have 1000X branding. You gotta be kidding me. I thought I was winning the branding war on 1000xstocks.com. I guess not. I'm losing a freaking Morgan Stanley over here.
2 years, and really the last 10 years, is high quality large cap stocks that can operate in the environment that we're.
I'm glad they let me know he works for Morgan Stanley, because really I was confused. I didn't really know.
And given and the environment, we've described this very clearly, which is we're in a situation where you're in a fiscal dominance, where the government is just getting bigger and bigger every year, and in doing so, they're essentially crowding out a good chunk of the private economy. And so, who benefits in the world that we live in? Large cap companies with scale who can operate in this environment. And that's what's working. So it's not just tech companies. I mean, it's consumer discretionary companies, it's healthcare companies, it's even some energy companies. Okay. Like if you have scale and you're operating well, that's what's driving the index higher. That's what has been driving the index higher. That's starting to change a little bit here recently.
That's just a bunch of baloney. I mean, it's just a bunch of baloney that was, equating two different things that don't even have anything to do with each other. The moral of the story is, like, the past 2 years, the top of the market has been doing tremendous because their earnings per share have been tearing it up. Look at the past 2 years for NVIDIA's earnings per share. Look at Meta's earnings per share the last 2 years. Look at Google's earnings per share. Look at Amazon. Like, go through the whole list of those top tier companies, and their earnings per share has been skyrocketing. And what happens when the most important stocks in the market, when their earnings per share is skyrocketing, right? Many of them up triple digits on a 2-year stack basis. Guess what's going to happen? The market's going to go a lot dang higher. So, that whole little speech there, that was just baloney.
7 underperforming since July, and there's a bit of a broadening out going on. But the broadening out is still happening at the sort of quality level, meaning the market still doesn't really want to go down the quality curve or to companies that have bad balance sheets, et cetera. They're just going into different high quality stocks across the complex.
Mike, we're kind of just starting to get into the teeth of this earnings season. We've had some really good numbers coming out of global Wall Street so far. What do you think the market needs to see out of corporate America over the next couple of weeks in terms of earnings?
Well, you're right. I mean, like as usual, companies have managed the numbers lower going into the quarter. That's not unusual. This quarter was a little bit more negative in terms of the revision. So that the bar has been lowered. They're going to jump over the bar. And with the market, like what investors what they're going to buy are companies that not only beat the lower bar, but then give you some confidence that there's actually some acceleration coming. The thing that's been missing in the last 3 or 4 quarters is we don't have any broad acceleration in order growth or, where's the exogenous positive growth shock going to come that's going to rise, lift all rising boats. And so that's why it's become very idiosyncratic, right? That there's a lot of winners and there's a lot of losers right now. And there's share gains going on. And those are the things that investors are keying off of. Who's operating well in this environment? And I think that's going to continue to be the game that's played.
I look at Mike Wilson like NVIDIA. You got Joseph Moore, covering. I know you guys aren't on speaking terms, but when you listen to a guy like Joseph Moore on NVIDIA at your Morgan Stanley, how far out is your terminal value on Mag 7 and on the rocket stock NVIDIA? Do you have to justify its existence by going out not 3 years, but 7, or dare I say a decade?
Actually, Joe and I had dinner last night with some clients, so we are speaking.
Okay, well, tell us about the dinner. No, stop. This is too much. Tell us about the dinner, Mike Wilson. Give us some insight.
It was very enjoyable. It was a very enjoyable dinner with about 20 clients. It's excellent food and great conversation. But Joe, Joe has had the right view. He's been very bullish on the AI winners.
See, that's what Wall Street's all about right there, baby. The nice dinners with the clients, and that's the life, man.
He hasn't been very bullish on the broader semiconductor complex, right? And this is a perfect microcosm of what we were just talking about. Even within semiconductors, okay, you have the big winners, which everybody knows, and then you have a bunch of companies that really just aren't seeing any acceleration in their business because the global economy is kind of and that's what we got. And so in the case of NVIDIA, Joe said a great call. He's not looking 7 years out because it's silly to try and predict that, but he is looking out probably several years. We talked about that last night, which is there's a lot of visibility for 25, and then 26 is when the visibility starts to come down.
I agree.
So the stock will start to discount that at some point. Right now, the momentum is quite good.
Mike Wilson, I got to ask this question.
My 150 to 200 prediction before year end is looking really good, is it not? And remember, I had that call on since the beginning of this year. So I don't think anybody, no, I know for a fact, because I pay attention to all these Wall Streeters, no one had that call on. And I'm looking pretty dang good.
We're going to come back with Mr. Wilson if he
good.
deems to.
Solid.
Mike Wilson, when you heard that James Gorman was going to Disney, were you like the football player leaving the field, we're going to Disneyland? I mean, what were your thoughts when your fearless leader who changed your company announced he's going to wander over and help Mr. Iger at Disney?
Well, that was a while ago. He's now the chairman of the board. It doesn't surprise me at all. James is really, really good at this. Managing companies. He did a great job here. I wish him the best, and I think it's exciting for him. So it's the next great chapter for him.
Yeah, Disney's making a bunch of moves, which they need to, because that company's been a mess as well. Another one I just want no base of, okay? Appreciate you guys. Thanks so much for joining me as always. If you want access to my premium courses, access to my Discord chat, you want to apply to join in there, click the pin comment down there, fill in an application. We'll see if we can get you access maybe next week. Much love and have a great day.